outgrew Apple. We outgrew Microsoft. We outgrew everyone. Were we lucky or smart? We were lucky.
If you think about the private equity business, you make 10 decisions a year, maximum. Everything else is ceremony. And how is money made? Well, over a long period of time in private equity, it appears that the secret to success is buying a good company at a low price and then selling it at a higher price. When do we, the sophisticated investors, spend most of our money? Given that we know low price is important, we spend most of our time buying companies when prices are high, because that's when financing is available. That's when people feel great. That's when people have confidence. And we do this cycle after cycle. And then when things get bad, everyone's overpaid, everyone's on defense. The ability to be a counter-cyclical thinker in this business, I think, is very hard and requires, just a commitment throughout the institution to a style of investing that can be unpopular.
And how do you train counter-cyclical thinking and being unpopular? A little bit comes back to the courage thing as well, right?
We try to do at Apollo, and there are, 4 or 5 things, but making sure we are a safe place for counter-cyclical thinking, for contrarian thought is great. And part of that is a healthy tolerance of intellectual insubordination, which is different than outright insubordination.
What is intellectual insubordination?
That means you can take on if you're a young professional in the firm and we're discussing an investment, you can take on anyone over the investment on facts. And it is not only tolerated, it's expected. You can have deal teams disagree with each other. As long as the facts are on the table, we make investments as a partnership, and we win and we lose. How do we know who was a good investor over the last 10 years, exclude the last 2?
I think it's very difficult.
I think track record is useless.
Yeah, so do I.
Look at the U.S. We printed $8 trillion from 2008 until 2022. When we print $8 trillion, what happens? Everything goes up and to the right. And everything did go up and to the right. Good stuff and bad stuff. Okay, if I picked out some names, which I'm not going to since we're recording this, and I asked you 3 years ago if they were good investors, everybody would be like, oh yeah, they're amazing. And now if I ask, 3 years later, no, they were just lucky.
Many of them are out of jobs.
Yes, many of them are out of jobs. I do think that is an element of being an investor, which, by the way, is different than running the business that I run today. The business that I run today is the ability to be a good investor is paramount, but the ability to identify big societal shifts, trends, and get yourself in front of these trends is much more important. We gathered the whole partnership in Abu Dhabi in January, all 201 Apollo partners. I put up a slide that showed that in 2008, we were 40 billion of AUM. And in 2023, we were 650 billion. So we grew 14 times. And then I said, we outgrew Apple. We outgrew Microsoft. We outgrew everyone. Second slide. Were we lucky or smart? We were lucky. How could you possibly plan on growing a business 14 times?
In a financial management business, yeah.
And right, we positioned ourselves in front of really big trends, and we were therefore taken along with those big trends. So what happened? You had a financial crisis in 2008. Financial institutions were on their back foot. They were weak. We stepped in when they couldn't do things. The world was pushing banks to do less. As banks did less, we did more. And then interest rates went to zero. Everyone needed returns. They were willing to look different places for returns. We provided returns. So it changed the shape of our business. The business today is 500 billion of credit and 150 billion of equity. It sounds big in this room, but in the context of the market that we serve, it's just not that big. The big bank CEOs don't wake up every day wondering what the mighty Apollo is doing. And I do think that is, in your business, it's about identifying the trends specifically around, is it AI, is it power, is it other things? In our business, it's what's going to happen next. So we look at the world and banks are still being asked to do less. Basel III endgame, everything else. That's going to be a big trend. The Western world is getting older. We're short retirement income. The provision of retirement income on a guaranteed basis is going to be a big business. Then I look at things that have happened in the stock market. Does the U.S. have a stock market? Do we have price discovery?
No.
I don't know that we do.
Especially not for small cap companies, for what it's worth.
So
right
80% of trading is S&P 500. 10 companies are 35% of the S&P. Those 10 companies trade at astronomical PEs. The whole market is basically levered to NVIDIA and Apple. I think the public markets have become mostly beta. And the reason I know that is I look at all active management of debt and equity. It's failed to beat the market 90% of the time for 20 years. I don't think we're going to have as much active management going forward. I think that we're watching in the next 10 years the demise of active management. I think it becomes more passive and more boutique, of which we are boutique. And I also think we're rethinking the whole notion of public and private. I grew up thinking that private was risky and public was safe. And when I started, it was. Private was 3 products: venture capital, hedge funds, private equity, and public were diversified portfolios of stocks and bonds. Now, private goes from AA to levered equity. It is both risky and safe. And public, we used to have 8,000 public companies. We now have 4,000 public companies.
And shrinking.
Going down. And we have massive concentration. First, should we recognize that public is both risky and safe? And second, shouldn't we expect more private, given that half the market is now private?
Well, maybe what's the other side of that argument, which is if you want to kind of be counter to the trend, there needs to be a market that develops for smaller cap companies and for active management. You don't think that happens?
I don't know.
That's bad news for the whole room here, just so we're clear.
I think it's going the other way. I think the question is one of exit. The private market, I think, wins at the expense of the public market.
Because of regulation? Like, why does it happen? Because the big pools of capital are just passive and algorithmic? Because
big pools of capital are passive and algorithmic. Now, the negative for our business, and it's your business and my business, is I think IPOs are going to be the minority exit for all businesses. And I think we're going to have to be really careful about how we invest to make sure that what we're doing is incubating for public companies to buy.